Welcome back, everybody. Doug Burson. I'm here live in Atlanta, Georgia. What's new in taxes in 2024? So that's what we're going to try to go over. I'm here at a national tax conference. We're getting the latest and greatest information, most updated court cases, all that kind of stuff. Today I've been in class for 8 hours already. I'm going to try to boil that 8 hours down into maybe 5 to 10 minutes of stuff that you can really use in your life, both for individual and for business. I'm here multiple days this week, so as long as the content that they're delivering is good, which it almost always is, I'm going to try to do this for you guys every day this week until it's over. I've done this before, and you guys have told me how much you really appreciated it. So I would say for a lot of you found it to be a lot more useful than the normal year-end tax letters that the accountants always send out. I mean, we're still going to do that. But let's be honest, you guys don't want to read through 8 pages of legalese. You want me just to tell you how to use it and make it easy. So that's what I'm going to try to do. And if nothing else, it'll at least hopefully trigger some questions so that when we're doing your tax return, you'll be more educated. Plus, if there's some stuff that you need to do before the end of the year, over these next several days, we're going to talk about a lot of that stuff too. So please, if you can, take the time to watch all of these this week, because they're really going to be aimed at helping you, the small business owner and the individual, and try to help you out. So with that, I'm going to have to look at my computer a lot because let's be honest, I was in 8 hours of classes. I can't remember it all, but I tried to make notes of the high level stuff. So let's go ahead and take a look at that right now. Okay, so to start with, the classes that we're taking this week, the manual is 877 pages long. And that's just for the primary class. There's also 2 other classes that go along with that that's even more. So there's well over 1,000 pages of information that we're going to be covering this week. So we're going to boil it down and try to make it simple. But we are really blessed here at this conference that we have some of the best instructors in the business, guys I've learned from a lot over the years. And so truly, I'm happy to be here and excited and want to share it with you. So the way I'm going to do this is I'm just going to go down through my notes just like they were in class and just go through it point by point. If there's any questions you guys have, make sure to drop them down in below. Maybe I can bring them up in class tomorrow. If you leave questions tonight, maybe I can bring your scenario right in front of the class. There's, I don't know, probably 150, 200 accountants down there plus the instructors. Maybe we can get an answer we hadn't even thought about. So don't forget to think about that as well. So to start with, one of the things we talked about was the Secure Act 2.0. A lot of that had to do with investments, but there's a few things in there that I thought would be helpful to you guys. So for those of you who are getting closer to retirement, you know, there's the amount that you can put into your 401k. Well, now for those starting next year, so this is more of a next year plan. If you're 60 through 63, you're going to be allowed to put $10,000 additional in, or 50% more than regular. So that's a pretty big deal. So we can really pile in money on that last big push before retirement. So those of you who are 60 to through 63 starting next year, this is a big thing. I just want to get it on your radar, make sure you're aware of it so you don't miss out. Now, we talked about this actually in my last video, so if you haven't watched that, I would recommend going and seeing that. We talked a little bit about the Tax Cuts and Jobs Act sunsetting. We also talked about that quite a bit today. One of the things he brought up for you business owners, and it was a good way of putting this, is Section 179. So a lot of you, you'll go out and you'll buy a big piece of equipment, and maybe it's 50,000, maybe it's 70, maybe it's 150. And the natural reaction is to write it all off now, because $1 today is better than $1 tomorrow. But something to think about is if you've got a 5-year note and you're making all these payments on that piece of equipment, and we took all the deduction this year, it's not a really good matching scenario there, and you're spending a lot of money in those future years with no deductions. And yeah, you're getting a benefit now, but it could make cash flow really hard for you in future years. So I just want to put that out there, something to think about. I'm not saying we should or we shouldn't. Everybody's going to be different. It's going to depend on tax brackets, what your growth curve looks like, a lot of different things. But it's just something to think about. It may not always be the best idea to write it all off now, versus maybe taking a 5-year deduction. Another really exciting one was the 529 plans. The 529s, and they passed this with the Secure Act, I believe, last year, I think it was. It doesn't really matter. What matters is you can now roll that over into a Roth. So let's say you put the money in for your kids and they didn't use it all. Maybe they got good grades and got scholarships, whatever the scenario is, but it's still there. You can now roll that over into a Roth and really give that kid a really good kickstart. Just imagine if you rolled that over, and you can do up to, I believe it's $35,000, but the account has to have been open for at least 15 years. But you can roll that over, and just imagine your child who's maybe 24, 25, 26, 30, I don't know. If you could give them a big kickstart with $30,000 in a Roth IRA right now, and then the time value of money kicks in for them, how much is that going to be good for them? So I wanted you guys to know about that one. That was a big deal. On the same concept there, this doesn't fit everybody, but some of you have more money in your IRA than you're going to spend. Let's be honest. Some of you do. Not all of us, but some of you have done really well, and you've got more than you're going to be able to spend. And with some of the things that have come out now, when your heirs inherit that, if it's in a traditional IRA, they have to take it out within 10 years. I mean, there's stuff there. We won't get bogged down into that. But as a general, they got to take it out within 10 years, and they have to take some out every year, and they're going to be subjected to income tax. What if you could get that into a Roth? Yeah, with the Roth, they still have to get it out within 10 years, but they won't have to pay tax on it. And so often, by the time your kids are going to inherit this, they're now in their peak earning years, and they could really get hammered on that IRA. So if you have money in that IRA, we probably really need to talk about beginning a Roth conversion. And we can do it over a ladder, manage your tax brackets, but it's something I really want you to at least be thinking about. And you don't have to be just for your kids, but just something I want to throw out there to start thinking about. Section 179 limits, we talked about that a minute ago, but the limit is going to be $1,220,000, and for your SUVs and your heavy trucks, the amount of 179 we can take in year one is $30,500. And so wanted you guys to know what those numbers are. Those can be very helpful on your tax return. So I just want to get that out there. Talk some things about mileage, the importance of keeping track of it. I've talked to you guys about that a lot. You use some apps out there. There's some great apps like MileIQ, TripLog, some stuff like that. We've talked about that, so I'm not worried about those things. QCDs. I've talked to you guys about QCDs before, but I really want to bring it back up because you could get a little tripped up on this. The QCD, which is qualified charitable distribution, so that's a scenario where you got to take money out of your IRA, and so you're pulling the money out, and then you're paying tax on it, and then you're going and making a contribution to your charity of choice. But you got taxed on it. If you're going to give to a charity already, why not take that RMD, and instead of taking it out and paying tax on it, and then not being able to itemize because the standard deduction is so high, why don't we go ahead and give that directly to a charity? And that's called a qualified charitable distribution. They work great. I've been promoting them for years. A lot of you guys are already doing it, but not everybody is. You may not be aware of it, or maybe you're just now at that age. But the thing is, it can be a little tricky there. The RMDs right now, that age starts at 73, your required minimum distribution. However, QCDs, you can start at 70 and a half. So I want to make sure you guys are aware of that. If you haven't done that yet, talk to your financial advisor. If you're at that age, 70 and a half or older, and you donate to charities, why are we paying income taxes? Because there's a lot of other things that happen there. Not only are you paying income tax, but when you draw that out, it also affects your modified adjusted gross income, so it makes your Social Security potentially get taxed higher. It could cause you to have to pay more in IRMA. Those of you who have Medicare payments that have been bumped, you know about IRMA. She's nasty. You don't want to deal with her. So this is another way that we can help manage IRMA is by using the QCD. On that same vein is something called the donor advised funds. And I've talked about this before too. But the donor advised fund is where, remember, the standard deduction's really high, about $30,000. So if we don't have enough to get over that, what some are doing is contributing maybe 3 years or 4 years of charitable donations in 1 year. That gives us enough to itemize so we at least get a deduction for it. And then using that donor fund, we distribute it out over the next several years to places that we want to. And that allows us to get that deduction. One thing to be aware of is the Tax Cuts and Jobs Act, we could, I don't think that we will, but we still have to at least talk about it. We could end up going back to the standard deduction that's half as big as it is. If that's the case, do we want to do the donor advised fund because we're going to be able to itemize again? Once again, I don't think that's going to be the case. We're going to have to pay attention. We'll talk about that more, but I wanted to at least make you aware of it. For you small business owners, the QBI deduction, that was that deduction for the 199A is another way of saying it. But where we basically got to write off 20% of our income as a deduction. And it's been really helpful for small business. That also expires at the end of next year. Will we get it back? I don't know. I think so, but who knows? But it's something I just want to let you guys know these things are out there. And most importantly, I want you to know we're paying attention to it. And when we get more, I'm going to let you know about it. So I've got a lot of questions on that actual subject of the TCJA, Tax Cuts and Jobs Act, and it being sunsetted. And so we did talk about that quite a bit and had some people in the room with quite a bit of industry knowledge and expertise that I trust and respect. And the feeling in the room and the feeling that they're getting in Washington is that we will probably get an extension on most of those. However, because of the way the rules work, while the Republicans, and this isn't I'm not talking politics here, just stating facts, because the Republicans, they did win all three sides, they didn't win enough in the Senate because you have to have 60% to pass things. And since that's probably not going to be the case, they'll have to go through reconciliation. With reconciliation, that means that we have to have a budget. And so things are going to have to be played with within a fixed budget. They can't just do whatever they want like they can with when they pass a law and then they put a time limit on it to make it work and all that. With this, they actually have to make the numbers work. So we're just going to have to stay tuned and pay attention to see what really goes through. I think a lot of it will get extended. I think the things that affect most of us are going to, but really, we just don't know. And so the main thing I want you to know there, like I said a minute ago, we're going to be paying attention. Go ahead and subscribe to this channel because if you remember back during COVID with the PPP, the ERC, the EIDL stuff, the child tax credits, we were on top of all that and we were getting information to you that was actually accurate and correct before a lot of the other people. You got to be careful with the news. They don't always know and they're trying to get ratings and all the rest of it. But we were one of the first to give you good information. So stay tuned. We're going to be watching this for you guys. That's what we do. And like I said, stay tuned. All right, so let's keep moving on there. I think I've talked about that enough. Salt tax, I talked about that in the other videos, so you can check that over there. We talked about BOI. Left a video for you guys on that the other day. So check out that one. We've talked about that, so we don't need to go through that anymore. He did say that there's a big push by the AICPA and several other organizations to at least get a 1-year extension on this. But so far, it hasn't gone anywhere. Nobody's really picked it up. A lot of people are asking for it. But at this point, we've only got a month and a half left, not even that, to get this done. So we're going to have to go forward with it. If something comes up, I'll let you know. But right now, we're just going to have to do it. All right. HSAs. Interesting concept there because HSAs, if you're healthy, you're contributing into them, you're not spending it. Well, if you're starting to get a pretty good sized balance in there, Most of them are not really invested well. They're get low interest bearing, hardly anything. If you're starting to get a balance and you're not using it, remember this HSA is very similar to an IRA. You may want to consider talking to whoever's managing that and see if there's some better investment options so that that money is performing for you, not just sitting there. So that was a nice little tip. Another tip was on the QCDs. We talked about that a minute ago, but the QCD, the Qualified Charitable Distribution, that's where you're taking money from your IRA and giving it straight to a charity. A lot of those custodians will actually give you a checkbook for this purpose. So instead of you having to contact your advisor every time you want to write some money to the church or to United Way or whoever it is that you want to write a check to, if you have that checkbook, you just need to keep track of it and you can do it yourself, which will make it so much easier for you, right? I think that was a great tip and one that I think you guys could really benefit if you're in that category. Social Security, we did talk about that right now. It's scheduled to run out of money in about 10 years. Where that's going to go, we're just going to have to wait and see. So I'm not going to get bogged down in that. But he did recommend, and he's told us this before, make sure you double check your Social Security account. So you can set up a Social Security account, go on to ssa.gov and verify your numbers are correct, because you want to make sure that when you go to retire that all your years got reported. And don't take this for granted. I've seen many, many times to where the IRS has holes and the person worked and we've had to go back and try to get that corrected. But if you've got a hole from 7-8 years ago and maybe that company's not around anymore or whatever, it could really impact how much you could be eligible for. And so it's just a good idea to at least every couple of years, it's not a big deal, check and make sure your numbers got reported, because sometimes, especially with the mail or even the electronic filing, numbers get lost. They get messed up. Somebody fat fingers something. It could happen. So really good advice. And the last one we talked about this morning that I felt like was at least worth bringing up was the 1099K. And we've talked about this before, but it's starting to come out and it's going to affect more and more of you. That's where places like in real world, somewhere that's really going to affect you, maybe you're selling stuff on eBay or something like that, and you're just doing it on the side. Maybe you're selling stuff out of your house, just personal property. You're going to get a 1099 if that amount goes over $5,000, and they might even send it if it's less than that. The important part I want to bring to your attention on this is if you get this, don't ignore it. Bring it to us when we're doing your tax return or whoever your preparer is, and don't ignore it, because the IRS is going to be trying to match those up, and you don't want to be getting notices and having to deal with the IRS. If your preparer is competent, they'll be able to help you through that, because maybe you don't even know any tax at all, or maybe you had a loss. Of course, if it's personal property, you can't deduct that, but don't ignore it. That's my big thing there. Make sure you take it to your preparer so it can be handled. So that pretty much wrapped up the morning section. All right, so let's move on to the afternoon. One of the things that was talked about there was home office for S Corps, and this comes up all the time. And when you had a sole proprietorship, we could just put all the information in and we could take a deduction right there on Schedule C. Well, with an S Corp, it doesn't work that way. And what you really need to do, we can still take a lot of the same things, but we want to make sure to legitimize everything that we write ourselves a reimbursement check. So basically do the same way, square footage, take your utilities, take your insurance, take your real estate taxes, mortgage interest, multiply it times that percentage, and then write yourself a reimbursement check from home office out of the S Corp. That will then make it a legitimate deduction, assuming you pass all the other home office deductions, obviously. But that'll make that work. So I thought that was a good tip we're sharing with you guys. Another one that's coming that could be an issue starting next year, and we'll see how a lot of these things go, so just stay tuned. But currently the way the rules are, the premium tax credit for the Affordable Care Act. Remember, a lot of you, if you got too much, you had to pay a lot of it back. But over the last couple of years, we've got a little bit of relief there. We're going to be going back to the 400% hard cutoff. So if your income is over 400% of the poverty line, then you will owe it all back. And it's been less painful the last few years, but that's something we're going to need to pay attention to. And I just want you guys to know that and just to be paying attention, and we'll see how things go. Next year is going to be a very, very important year with taxes. So once again, I recommend you subscribe because I'm going to do my best to make sure you guys aren't caught off guard. We talked about a few things. I'm not going to worry about it, like moving expenses. They're not deductible now unless military. That may come back depending on the extensions. Stay tuned. I'm not willing to say much about that. We talked about the sunset. I'm not going to worry about that. Just beware politicians. They talk a lot. They say a lot, but they're politicians. So if you remember during COVID, there was all kinds of stuff coming out all the time, and then we'd find out later that that wasn't quite right. So just beware of who you're getting your information from. That's all I'll say on that. All right, moving on to the clean vehicle credit. We talked about this a little bit because there's some interesting twists there. But think of your cars like your Teslas, and there's other cars that qualify for these credits. But you can get up to a $7,500 credit. But you got to remember there's income limits, and I've seen some people get burned on this. If you make over 300 married filing joint or 150 single, you don't qualify. The big problem we have right now is over the last year, you've been allowed to get that $7,500 credit straight from the dealer. Sounds great. Maybe you can use it as down payment and all that. Problem is when we do the tax return, we have to reconcile that. So if you told the dealer, yeah, give me the $7,500, but you didn't qualify, you're going to owe it back. And that's a big thing that I think a lot of people may not be aware of. Another one is maybe you didn't qualify for the full amount because the credit is not refundable credit. It can only offset tax. So if your income is not high enough to have $7,500 of tax, then you're not going to qualify for $7,500 of credit, and this credit doesn't roll forward. So maybe your tax liability is only $3,500. Well, that's all the credit you would qualify for. And if you got the $7,500 when you bought the car as an upfront, you're going to end up owing the $4,000 or $4,500 back on the tax return. And so I want to make you aware of it now, and especially for those who may be looking to buy one, this can be a big deal. But there's one interesting part on this. Let's say you don't qualify. Maybe your income is too high, or maybe it's too low. Although if it's too low, you shouldn't be buying one of these cars anyway. I'm not your mama, but come on. But let's just say your income's too high. If you lease, which normally I'm not for leasing, but if you lease that car, that a lot of times they will give you that $7,500 credit assistance to buy the car, but it's really just a reduction of price because when it's a lease, the credit stays with the leaseor, or I think that's right, the leaseor, the company who's doing the leasing. So while they may give you a credit, that's really their tax credit. And so if you didn't qualify, it's okay because they're the ones that really got the credit. They just gave you a discount. And that's a big distinguishing thing. So if your income is over $300,000, you're thinking about buying one of these cars, or over $150 if you're single, and I don't have it here. I think it was like $180 if you're head of household, but don't quote me on that one. You may have to look that one up. There may be an opportunity for you still to get that by negotiating that into the lease. And if that's you, maybe we should schedule an appointment. It would probably be worth your time when we're talking about $7,500. So there's that. I want to make sure you guys saw that. Been a little bit of change on the energy credits. Some of this started kicking in a year ago. But if you remember back several years ago, there was a lifetime limit on these energy credits for your house. Think insulation, windows, doors, water heaters, furnaces, those kind of things. There was a lifetime limit. So if you used it once, you'd probably used it all up. Well, that has all changed now. We've talked about that last year, but I'm sure a lot of you have forgotten. It's now $1,200 max per year. or $2,000 for your heaters, water pumps, and your like biomass stoves, like your pellet stoves, things like that, if they qualified. And the place you're buying them from will usually know if they qualify for the credit. But that's an annual thing now. So that's different, and I want to make sure you guys were aware of that. So it's a 30% credit like it was, capped at $1,200 and capped at $2,000, and that's how that works. Now there's the solar credits, and if you're going to get into solar, there's a lot of little things. 30% credit, it's not limited, and that credit generally can roll forward. So I've had some people who have done it, and we got to use the credit over a couple of years. That can be a pretty good deal. But if you're going down that path, it may be worth getting a consultation just to make sure this is going to work out the way you want. Because the thing is, if you don't have tax, you don't get the credit. So if you're only paying a couple $1,000s a year in taxes, and they're promising you a 30% credit, and you're spending 30 or 40 grand, how long is it going to take you to recover that? So just be careful with that one. Remember, he's a sales guy, and he's going to tell you stuff, but he's not a tax person, or she. So just be careful with this stuff on these credits. You got to have tax for it to work. Then we talked about personal use days on rentals. That's too complex for this video, so we won't worry about that. We might do that in a future video. Talked about the IRA 10-year rule. I think I covered that a few minutes ago, but if it's a traditional IRA and you inherit it, as a general rule, there are some exceptions, but as a general rule, you have to take that out over 10 years. And as of a few months ago, and we covered that in another video on IRAs, so you can go double check that. But you'll need to take money out every year starting next year, so that's a change. Whereas you used to hold off till 10, might not have been smart, but you could. Now you can't. With Ross, you still can. Like I said on that, check out our other video. So that's about it. Tomorrow, we'll probably get into stuff that's a little more detailed. This was all high-level stuff. We're here for 4 days, so it tends to build on itself and get more detailed as we go. So stay tuned. Follow me tomorrow. I'll keep you up to date, and we'll be back home soon, and tax season's getting close.